right, all right, all right. We're here. We're here.
You ready? Here?
We
For
are.
real?
We're as ready as we're gonna be because we're live.
Totally.
Yeah,
I'm sorry.
I get it. I get it.
That's all I got right now.
What's up, everybody? I'm Mark Monroe, and I'm accompanied by my wonderful co-host, co-producer, co-creator, coming all the way from Galactus, but also being an awesome and phenomenal catalyst, the wonderful.
jolyngc, what's up? How you doing?
I'm good. I'm good. I'm as good as I'm gonna be, but uh, before we get started, just wanted to just have a moment of silence because for those of you that don't know, um, 2 o'clock Central Time today, I lost someone that's very near and dear to my heart, um, and I just want us to have a moment of silence for my aunt, Angela Haynes. Uh, you've Without you, I wouldn't be standing here today. So the best that we can do is for me, I'm going to try to make it one of the most legendary episodes that I can for each and every single one of you, but also to my aunt, you know, give me some, give me some of that energy of, you know, get it done, take no prisoners attitude. So if we can, just a moment of silence, please. Thank you. All right. Welcome to the Come Up series. For those of you that don't know, this is a show every Tuesday and Thursday. Our goal is to give you as much of the game as we can, hence the name, The Come Up, because it's for you and only all of y'all. So tonight is definitely going to be all about vision, but if you haven't subscribed yet, go ahead and hit the subscribe button down below. Hit the like button because it definitely gets out to many other cousins out there that are definitely looking for their come up. And on top of that, if you want to be in the know, and who is first today, Jolyn, since you were out here?
I was first. No, I'm just kidding.
I mean, that's
First
fair.
is often Lady of Leisure. Totally. All right, we have, I think it was Hen. I think Hen was first.
Okay.
Was that who you had?
I don't know, because my chat has been completely like not working. So
I'm gonna call it Hen because that was the first name that I saw when I first logged in.
Well, shout outs to you.
Yeah.
All right, so Jolyn, how do we do in today's market?
What does it, cousin? Let's get into this market. So the Dow was negative 50.63 points. Now on Monday, y'all, it was down by like 900 points, and so it recovered about 200 points. Many could consider that, an opportunity, a gift, depending on, your research, what you were trying to get into. The S&P 500 was negative 3.54 points, and the NASDAQ was the only one that was green at 32.50 points up. And we have the VIX increased to 24.36 points, but on Monday it was higher than that. So it came down a little bit, but it was, just last week, this was in the teens, so.
Yeah.
We got some panic based on different events that happened in the market on Monday with Evergrande and all that. So we'll talk a little bit more about that. But the 10-year Treasury note is 1.321%. That came down a tiny little sprinkle. Heading over to sector performance, as you know, there are 11 sectors, and we track the top 3 and the bottom 3 so we can see what that rotation is looking like. So we have energy, health, and consumer discretionary in the top 3 spots. And for our bottom 3, we have utilities, communication services, and industrials. Interestingly enough though, Mark, industrials has been outperforming all the other sectors. When you look at the chart, it's way up there. Although it's now between the other sectors starting to narrow down. You could just take a look at that chart, y'all, when you have some time. Just put all of the different sectors in there, and you can see for yourself what that's looking like. And then we have pick performance, and you can find the Come Up Series picks on our Instagram page at that Come Up Series. And we have a Lucid, Snap, and Hood holding down the top 3 spots. And we have Eat, Disney, and DraftKings holding down the 3 bottom spots, all coming in at negative performance today. Mark, we have several questions that we didn't get to yesterday because we had church last Thursday.
Yes.
So many we didn't have time for testimonials. The choir only sang an A selection. They were supposed to do an A and B selection, so we didn't even get to all that.
We didn't even get to the announcements. No, nothing. We just went straight into sermon.
Straight into sermon, and it was all good. So we can take a look at a few charts. Definitely the S&P or the SPY.
Glad you asked, because I'm gonna actually do a few. I actually have them lined up.
Great. Definitely. Let's take a look at the VIX just, off GP. And also, I don't want to look at Lucid, even though it is in the top. I also don't want to look at Snap or Hood. I don't. I don't. So I'm looking at some of these, some of the bottom 3 today, which was Eat, Disney, and DraftKings, and really just for like the lesson of it all, and looking at some of those ones that pulled back, like SMH had a pretty decent pullback, panic sale. So if we could look at some of those, that'd be fantabulous. And then we have a whole bunch of questions, so we'll definitely get into that. And Mark, it's my understanding that you want to make this episode legendary, and usually when you say that, I know it has to do with something that you've been working on.
Yeah.
And I'm not anymore. I'm gonna let you rock.
Okay. All right. Well, let's cue the transition here.
All right. While you do that, I'm gonna pull up some of these questions.
Okay, so the first chart that I'm looking at is the VIX, aka ticker VIX, the volatility S&P 500 VIX. So here's a little bit of a lesson about the volatility index. A lot of folks think that it's just completely associated to the stocks on the market, but au contraire, it is not. The VIX is actually a read of the options market, so which means that the put to call ratio, as well as, say, for example, things that are further out of the money, and as well as the type of open interest that's ultimately out there, and on top of that, alongside with how the stock is actually playing out, can create volatility within the market. So, for example, when you think about it, a lot of your market makers, they are the ones that are ultimately allowed the execution of such options. And if you ever find yourself in a position where you're trying to execute options and it's not executing, though that you're at the asking price and everything else, it's probably because a market maker hasn't been able to fulfill it yet because of the fact that they're dealing with X amount of flow. Now, it's pretty instantaneous, but sometimes when the volatility is high, it does that. So, one of the things to look at is, as we're looking at this VIX, notice we came from a 37, and if I really zoom it out on us, we came all the way from 41. And then if I really zoom it out all the way to 2020, where we were at the height of March 18th, 2020, we were at pretty much almost 90 in the VIX. And then let's bring it in on a year-to-date chart on a daily. So if you're looking at this, you're seeing that over time we've been coming down. But notice when we find ourselves in these places, like for example, February 25th of this year, March 4th of this year, and then also May 12th and May 13th of this year, we found that the VIX had significantly spiked. And we're talking about between the ranges of about 25 or 23 all the way up to about 28. Beforehand, we were at about a 31. And so to put it into perspective, we came all the way up to that same 28, and then essentially we came down. A thing to know about the volatility index, normally the VIX is like a rubber band. It's like it immediately expands, and just as much as it expands, it snaps right back. So one of the things, if you journey back in a few episodes where I was talking about, if the VIX goes to 23, then that's a sign that we're in correction. If it gets to about 20 to 23, then that's a sign that we're getting ready to have the strong pullback. So we got to 23 in the volatility index and got all the way up to 28, which really put a lot of stocks in correction. Not really the indexes, so to speak, more like 5%. But here's something to keep in mind. 5 to 10%, that's about a correction. Anywhere from 15 to roughly 30%, that's bear market. So that's ultimately what we would consider as a crash. Now, for the record, just to take myself off screen really quickly, or to bring myself back on screen. So when we think about crashes out there, everybody, think about it like this. There's the crash of 1929, there's the crash of 1987, there's the crash of 2000, there's the crash of 2008, and then there was the crash of 2020, which was the pandemic. Notice I literally just calculated just 5 crashes over the history of, say, for example, the stock market. And when you think about it, each and every single one of those had many different indications as it pertains to how is it that we got there. So it wasn't just one specific thing. The market doesn't crash every single year. It may correct, but that's just a way to reinforce that the bull market is here to stay. So I want you to just keep that in mind, because a lot of times what people will feed you is some BS to let you know that we're crashing, but in reality, we're just having a simple correction that keeps everything copacetic. Back to our regular scheduled programming. So then let's take a look at the S&P 500. Now notice we've come off those highs on the S&P 500. And so now we've come well below the 50-day, and we've crossed the 5-day, has crossed over all of them. We've seen this before, kind of like around the time that we saw in March, and then on top of that we had a little bit of reticence in May. We could be going for this correction where we come down a little bit closer like we saw in September of last year, as well as October. But remember, October, that was more so led towards, say for example, the election. That definitely played a role there. So just keep that into perspective, in the sense that we really need some strong catalysts here. And the thing is, I think I had mentioned this, I don't know, keep me honest if I did or if I didn't, but one of the things that I had mentioned a few weeks ago was watch Apple, because Apple will definitely dictate whether or not we're going to go into correction or if we're going to go into a strong pullback. And sure enough, what happened, Apple essentially didn't exactly wow everybody with its product announcements, which that's fair, which ultimately led to the market saying, hey, there's really no other catalyst here, and there's a lot of other things that are taking place. So essentially it's kind of like, all right, well, Wall Street themselves, they're already in a shorting mood, so it made sense that we see ourselves in a pullback. But again, don't let pullbacks or even corrections ultimately scare you. This is the real time where the go-getters, they start going to get exactly what it is that they want. So just keep that into perspective. Now on to Disney. Now Disney has had quite the tumultuous year this year, coming actually below its actual, so it's actually negative if I'm correct for the year. Will this be exactly what we will see going into the close of this year? I don't think so. I think that what we're going to see here, and this is a huge amount of institutional selling. My guess was it was probably Goldman Sachs, because Disney was holding an event today, and Goldman Sachs and many probably other investors in the room did not like what they heard from Disney by saying that, okay, hey, the Delta variant has had a huge, it could have a significant impact as it pertains to our theme parks and those types of revenues. Well, the reason why you saw this really play out today, and most folks will be like, okay, well, that's not really much a big deal. The problem is that Disney had mentioned a while back that, hey, Disney was saying that, okay, hey, well, we don't really see that much of a huge impact in moving forward in their guidance and their earnings. That, hey, that, we're not going to see a strong impact from Delta variant in our earnings moving forward. So now the market's like, okay, hey, well, you just said this, but now you said this. And that's what caused confusion. And remember, Wall Street does not like confusion. They want your yeses to be yes and your nos to be nos. And so shout outs to Disney for getting ahead of it, though that essentially I think that they should have just played this card during their earnings. But I mean, hey, to each his own. I think that ultimately, this is ultimately you seeing the reaction from institutional money that's taking place. Will this be something that will last forever? Probably not. This is ultimately when we see this, we see the market react. It'll probably be sitting in the doghouse maybe for a week or two. And then after that, people will start to come back and say, okay, hey, I still see that there's strong value in Disney. And at this point, I feel like the bad news is already baked in by this point. So then let's move on to SMH. And if you notice, the semiconductor market had gapped down significantly all the way down to its 50-day moving average. And though we saw some like a slight red candle on this as it pertains to volume, I think we technically still ended in the green today, if I'm correct. If I'm wrong, hey, I'm sorry. But we're trying to bounce off of this 50-day moving average. I think that what we'll be looking for is probably over the next few days for that confirmation to let us know that, okay, hey, that all the coast is clear. And I think that ultimately SMH just happened to be alongside with the rest of the tech sector, along with what's coming out of China. Because here's the thing. You probably have heard by now that there is a little bit of controversy coming out of China as it pertains to what is called Evergrande. And pretty much they're holding about $300 billion in debt. So I'm coming off screen just to give you an explanation. So pretty much they're tied to a ton of real estate on the commercial side, from suppliers, supply chains, corporate business offices, retailers, you name it. And then on top of that, what spooked the market, and especially since Asian markets have been closed due to holidays, so we'll kind of get an idea of what that looks like, but my guess is we'll probably see selling take place because of the uncertainty there and the just knee-jerk reaction. And I think that this was just the U.S. markets getting ahead of it. And so essentially people are starting to wonder, well, who could be impacted here within this space? What commercial businesses can be impacted, especially on the supply chain? So of course you start to think of things like materials, semiconductors, those types of things, along with chip supply shortages that are still taking place and still haven't subsided. My guess for chip supply shortage is still remaining tried and true for mid 2022 to like early 2023, where we should see those issues have significantly been alleviated. Not fully rectified, but just essentially we're moving out of the darkness as it pertains to supply chain issues. So if I go back to our chart and pull it up for everybody and looking at SMH is definitely indicative of that, alongside with the players that are in it. So again, I would be waiting for confirmation here on the SMH ETF. But right now, the pricing looks good. And on top of that, we're still seeing that, we're starting to roll over in this bull trend where we're seeing the 21-day start to dip as well as the 50-day. But essentially, we're still in an upward trend. I still see nothing but upside for SMH, and I still see strong growth ahead. So we may have some short temporary pains here and there, but for the most part, we'll be all right. And
I do want
go ahead.
to something about SMH. So yesterday, the low that I thought, it could have been lower, but the low that I saw was in that 261 range, and it did not stay there that long. Like, I think I blinked and that joint like jumped up. And between yesterday, actually I think it was, well, either between yesterday and today, it hit to the 265, but then ultimately it closed at 264, which was higher than what it was doing for its low yesterday.
Correct.
It definitely gave kind of like that vibe of, okay, we're just gonna park here for a moment. So we had a lot of people, even though there was a lot of selling off, there wasn't that much sell off in SMH. It pretty much held strong because it could have easily went back further down. A couple couple weeks ago, I think I was talking to Tebow about this. It was in that 240 range. And I
Yep.
was like, who is this? This is SMH. But the day, like I think it was last week, it was at 271. So if you look at the difference between 264 and 271, even if you did not get that 261, looking at a 264 entry would have been okay. But then also that confirmation piece is key, because that confirmation it hasn't happened yet unless you got in at 261.
Yeah, and it's still not a bad price. I mean, essentially,
Yeah.
if you got in at the 261, mazel tov to you, but now you're still, of course, waiting for confirmation just to make sure that there is still no potential downside risk to bring us back down to either retest or to go a little bit lower than the 261. Because, of course, there is that gap to fill down there between 259 and 257. And some change. So just something to be mindful of there. But for the most part, SMH is pretty much holding steady. It's pretty well diversified, and of course, there's a lot of players in there. Just to be on the safe side, just again, wait for the confirmation.
We have some questions, Mark.
Let's do it.
All right, let me pull this up. Now, I'm not going to call nobody out, but some of y'all had some questions that weren't even for us. I think you meant to put them in Google. It's all good though. Some of y'all I had mercy on and I just answered your question. But seriously, before you have a question, put it in Google, because I'm sure it's there. And if it's not, then those are the kind of questions that we want to talk about. Or if there's a particular angle or perspective or what have you that you're looking for, let's talk about those types of things, because this is season 3 now.
Yes, it is.
We have growth now. We're grown now. All right, so we have several questions. A lot of the questions have to do with the correcting, like if we're already done.
Yeah.
But we kind of pretty much talked about that already. So unless there's anything else you want to add to that conversation, I think we're pretty much done with that.
So just to add a little bit of slight sauce and seasoning or some garnish on top of what was already cooked. When you're looking at confirmation, really start to look at those volumes and start to see if those selling volumes are starting to subside. So normally when you see those drops, the drops come heavy early, and then essentially they start to kind of dissipate, which is kind of like letting you know the flow of sellers is starting to subside. So that's something that you definitely want to look at as a confirmation. And then on top of that, what you also want to see is where are the buyers starting to step in. So where we start talking about the buyers, are we starting to see that we've reached a price level, aka 9 times out of 10 at some area of support, where we're starting to see buyers come in and start to nibble at the stock, or to ultimately start to buy in at big paces. So when you see that, the first thing is that's a signal, and then after that, the next thing you look for is the confirmation. See if that continues out. The worst thing that you can do is on a hellacious green candle, and then all of a sudden that green candle the very next day we just literally drop like a rock the very next day, which is aka known as a dead cat bounce. So you definitely want to make sure that essentially that there's confirmation that this market is still on its way up, or if the position itself is in recovery. Once you've been able to confirm that the position is in recovery, pick your prices accordingly.
Here's a question. This was about indicators.
Mm-hmm.
The question is, why do you prefer the 21 MA to the 20-day MA?
It just gives you extra data by 1 day. I mean, and then on top of that, some folks look at it on a 21 and a 34, and then of course I never deviate from the 50. If I really want to stick to the 20-day, I can actually just play the Bollinger Bands, which gives me, say for example, the high, median, and low, and that median is typically the 20-day moving average.
I'm not sure if we want to answer this question now or later. All right, here goes one. How do you overcome PTSD about leaps after the downturns of ARK and AMD?
For me, it's I take my losses. I mean, it's all part of the process as it pertains to me going higher. you know, it's like you go through those moments of either frustration, anger, or also scared because of the fact that, you know, hey, you know, you took a loss. But here's the thing, it's like, and I want to say this to everybody, like, you know, to put it into perspective. You know, many of y'all before the Come Up series, you had a plan to probably work at a company for anywhere from 10 to 20 years. And so essentially, you know, sometimes you're going to go through setbacks. There's going to be setbacks in the process. I mean, I face a multitude of different setbacks, and sometimes they just don't happen. I think that, you know, one of the biggest things that helped me get over it is trusting in myself and knowing exactly who I am. If you ever need that confirmation, go back and watch Thursday's video with Q, because he really kind of like sets it in for you, where it's like, you know, these things are going to be a part of the process. Like, nobody is ever going to step into this market and literally bat perfectly or just literally trade or invest perfectly. That's not going to happen. And if you think that that's going to be the process for you, then honestly, you're doing yourself a huge disservice. It's okay to set high goals, but it's also smart to have realistic goals. So essentially, one of the things that you can do is also mitigate your risk. So have areas in which that you can mitigate and say, hey, this is an area in which that, you know, for me and my plan, I'm going to step out, and be okay with it. And also, when you take a loss, you know, the more that you focus on what is it that you can learn from that loss versus feeling bad about yourself in the loss, you'll tend to recover fairly quickly, and then you'll probably start to notice the market will probably start to show you things and show you from your lessons, and from those lessons you may even start to see new opportunities. You may feel a little bit gun shy, of course, especially if you're just getting started, but yet at the same token, this is part of the process. And I think about it like I wrote on Twitter the other day, like, you know, going from a $4,500 loss my freshman year in college to literally an $18.2 million loss, you know, what is that? You know, over 10 years later, like, what is that, 14 years later? And then as of recently, taking an even heavier loss than what I took in 2018. But then I look at it and say, but look at the trajectory of, you know, where I've been going, kind of like a chart, like a stock on a chart. Of course, it's easy to pay attention to the dips and everything else, but then you got to zoom out and look at, okay, hey, how far have I actually come? So, you know, that's the thing that really helps me get over it, especially in the moment.
I want to add to that. What can really make the difference, and this applies across the board, and I know like that phrase was used in jest, but we can't even speak that or even have that type of mind frame over something as simple as a portfolio, because the definition of PTSD is a psychiatric disorder that may occur in people who have experienced or witnessed a traumatic event, such as a natural disaster, a serious accident, a terrorist act, war, combat, or rape, or who have been threatened with death, sexual violence, or serious injury. So we got to first start with being mindful of our words and our language, because words really do impact how you think about things and your beliefs about things. So you can't even play. This is not for play. So you can't even play with phrases and words like that when it comes to your portfolio, when it comes to your wealth journey, any of that. So again, and I know, like, you know, those kinds of things are said in jest, but we're not playing. There are no games being played here. So when we think about what we're up against, it's not PTSD when it comes to our portfolio. So I just want to first start with that.
It's just more so in the sense of just like doubt, and also the fact that, you know, it's the emotion part of like that makes us human. You know, it's like when you've done something and you thought that you did the homework or whatever it is, and ultimately you've taken the loss. It's like, it happens. You know, for me, like, I try to look at it from the fact of what is it that I can learn here in this process. Like, for example, in taking a $240 million loss, here's what I've learned. One, it's like my thesis, I felt like my thesis was good, but at the same token, market sentiment didn't agree with me. I didn't foresee a meme stock craze coming along from Wall Street Bets. I didn't see that one coming. I don't. If anybody saw that one coming, then hey, there's still a lot more that I could learn, because I don't ever consider myself as the guy or the ultimate guy. I mean, I look at it in the sense of there's more for me to still learn. I also realized that, hey, on some of those plays, hey, I could have easily gotten out. I could have easily said, okay, hey, it's time for me to exit stage right, but my rule is, and my trading plan, and I'm probably sure that Jolynn knows that, is when I'm 100% convicted on something, I'm going to stick with it no matter what. And I've already made up in my mind that, hey, that this could really screw up. And that's really the humbleness that comes into it. So for example, you have to have that, like an entrepreneur, you have to have that brazen bravado to say that, hey, I can push something out there, or I can execute on something. But you also have to have that deep humility that says, hey, that this could screw up. So it's like, be brazen, but don't be arrogant. And then also be humble, but don't be timid. That's kind of like exactly how I see it in the form of for investors or for traders. And I think that those are some of the greatest lessons that I've learned, and I continue to learn.
So we have, I'm not sure how much time you're going to need, but I think what you're going to share is probably going to spur some questions, and you definitely should take your time on it. So
let's go.
Let's transition.
Okay. So, I always said, I would kind of like lay it all out there on the line, and I feel like, why not today? So hopefully everybody can see this. If you can't, then I did my best. So let's zoom in real quick. So for everybody that needs understanding, let's take it from like the initial thing, in which that many of you remember what this is. This is essentially a rolling force strategy. Now, my goal is that, for me, I'm always trying to perfect something. I'm always trying to improve it. But today, it's like, you know what? I'm just going to show it all. Because ultimately, this has been the blueprint of setting forth things to put it into perspective. Now, a while back we said, okay, hey, if you started off with, let's say, $15,000, I kind of put it out there. And so let's just go line by line, shall we? So if you start off with 15,000 and essentially you were doing the rolling fours, this is ultimately how you would do a basic breakdown. And then ultimately the next line would be your year two return. Now notice what I've done is I've also, even myself, I've come back and I said, okay, hey, let's get a little bit more conservative here. So year one return, and then plus adding in year two, we bring forth another position of, say, for example, another 15K. Now, of course, a lot of folks ask me, hey, Mark, do I really have to do the 4 times every year? No. If you want to do it twice a year, great. If you want to do it 3 times a year, great. If you're really feeling that brazen, you can do it once, but my suggestion is that, again, I'm not your financial advisor or anything like that, so you should definitely consult somebody. But I would definitely say you could, but I would say sweet spot would be 2, 3, and 4. And so essentially you put it out there and say, okay, hey, here's year one return, and then here's the start of year two. And then, of course, the return is, given that we have a year one, that brings us to 37.5. Now, of course, everybody remembers that part. Everybody remembers this portion here as it pertains to just going through 4 years worth of dedicating your time and energy just towards perfecting and ultimately just doing long-term investments. Now, of course, it's like, do it within reason, for sure. But yet at the same token, if you understand what those XLK 130 January 2023s look like, and if you ultimately stuck it within that, if you stuck to the script within that foray, then okay, cool. At the end of year 5, this is kind of like what it totals down to. And I kind of did, like, say, for example, 2 trades within that year instead of doing 4. And there was a reason why, because it's kind of like the setup stage for, say, for example, the game-changing moment. Now, notice over here, you still have these things running as kind of like your runners that are still out there running for you. But at this point, your life is getting ready to change. Your life is significantly getting ready to change. And here's the reason why. Because now it's like you've reached, let's say in this example, if you started off with 15 and you literally just averaged about a 150 return, then essentially you'd be sitting at about a, of course, if we just hypothetically did a 200, then essentially what you're looking at is about 1.75. And then you take that 1.75, and then this is where we start talking about that monthly dividend. So for example, if you take that monthly dividend and say, for example, store 75% of that cash, that puts $1.31 million to the side. This goes nowhere. It just sits there. It just produces a monthly dividend like clockwork. I'll get to that in a second. And the reason why we do that is because of the fact that this is where ultimately you use the market to pay you. Now, if you want to, you can be smart and ultimately literally do this underneath a business and literally let the business literally collect the revenue and then ultimately let the business take care of everything. Of course, consult with your accountant and again, your financial advisor. But this money goes nowhere. But from 1.31 million, you literally turn that into an annual salary of $210,000 a year annually. Not bad. I mean, of course, if you need more, then, that's up to you. I mean, I've always believed that if you're living off of less, then you can do magnanimous things later on down the road. But who am I to judge? So then the interesting thing is, if you divide that by 12, then that means that you're making about $17,500 a month. So just put that into perspective. A $15,000 investment 5 years later produces the opportunity for you to literally collect a 16% monthly dividend, or a 16% annual dividend that literally breaks it down to a $17,578 a month as it pertains to cash flow. Then of course you put the rest of that 25% in cash, and you put that towards stock and let that go sit in something on a 15% year over year. So now you got a 15% year over year. So that 439 turns to 505. 505 turns to 581. 581 turns to 668. 668 turns to 768. 768 turns to 883. And that's over, say, for example, if you did it over, again, a 5-year span. So again, and then on top of that, you're collecting 210. So $210,000 a year for, let's say, that time period. Over 4 years, that's $843,750. Like just let that sink in for a second. Now, of course, you've had this other rolling force still going. So, of course, if you let that still keep rocking, 2.5 is the exact same thing as, say, for example, 150% return. And so, again, if you let that keep rocking, then that builds up to about a $3.6 million. And then, of course, you have your monthly dividend cash that's just still sitting there. It's not moving. But yet at the same token, the reason why it's not moving is because it's sitting in a monthly dividend account and ultimately just paying you on a monthly basis. And then, of course, when you think about all of the assets or all the net worth as it pertains to liquid net worth, that brings you to about $6.07 million. Now, of course, some folks are going to be asking me, hey, Mark, can you put this out somewhere so that way we can play with it and ultimately, see exactly how our financial situation makes sense and everything else. I'll see what I can do to do my best and release the document for you. But let's just say, for example, if you did it at $25,000 a year, then as you can see, again, you can build it to the point of, again, being consistent. Now, I'm going to do something that's very, very interesting here. So let's just say, for example, hypothetically, that some of your positions just don't rock right. They just don't pan out. So let's say we'll zero this out and we'll zero this out. So that means that you're batting 50%. So even when you're batting 50%, that would, especially from a 25K initial investment, that brings you to, again, a net of, let's say, $1.4 million over a 5-year span. And then again, that also allows you to put it in a sense of an MLPDX or anything that gives you a high dividend for an annual that pays you on a monthly. You still have a fairly decent salary and you can still do some pretty good damage here. Now, what I did was I did an aggregate on growth, so the growth of the stock. So this is not meaning that this year it grew by 30%. This is just that at 50%, 15% this year, then add another 15% as it pertains to the growth of the stock. So that brings us to 30% on aggregate, and then 45, 60, and then 75 respectfully. And then of course it's like, this is ultimately how you build that wealth for yourself. This is ultimately the name of the game. These aren't leverage plays, these aren't scale plays, these are just simple liquidity plays and you just sticking to a script. I mean, I wanted to make sure that that's very clear. You don't have to do anything extra. You don't have to do all this ridiculous, movement and everything else. You could just literally keep it simple. The thing is about the walk away, and one of the things that my aunt always taught me was just like, be patient. A lot of times it's like we want to make it to the promised land, but essentially it's like, what good is making it to the promised land? Is like, especially if you ain't ready. What happens when you're free but you're not ready to be free? Like, what happens when you make all this capital but you still have all these bad habits? The thing is that, when you're going through this process and letting your position sit there and cook and do what they're supposed to do, then essentially it's like you're also training yourself for essentially what that life looks like for essentially when you actually reach that area of wealth. I mean, again, this is your own financial plan. So again, it's like people are saying that this is out of reach. This is at $5,000 for initial investment for the first 2 years. So you just literally put in 10 grand over 2 years and you've invested it however you did. And then on top of that, some folks will say, okay, hey, well, I ain't got that either. This is at 2,500. So notice each of these positions are at $625, say, for example, on a quarterly basis. And yet, at the same token, a person can still make it to $1 million in net worth. Now, of course, it's like, annual salary of 35. The goal is that you keep getting better and better over time. And keep in mind, something to keep in perspective, a lot of folks will only stay focused on this side. They'll only look at the world from this side. But keep in mind, if you did this right, you have a whole world over here building at the same time, while, say, for example, this is the side that pays you. It's literally a 5-year focus. And sometimes it's like, again, you're going to find yourself in positions in which that sometimes it may not work itself out. But yet at the same token, it's like, to not put the energy in and to ultimately expect that the walk away just comes that easy. I mean, think about it. Even if I did this over a 5-year span, just thinking hypothetically, even if you did this over a 5-year span and essentially you said, okay, hey, I'm going to just dedicate my time and skill and craft to this for 5 years. I mean, just think about it. That even shortens up your, say, for example, your walk away, which you had already planned to put the time and energy for 10 years or 20 years at a company. Imagine what this looks like if you are able to continue to keep this going over the next 5 years. Like, that's the point that I want each and every single one of you to think about. The more that you put time and energy, you have to put this into perspective, y'all. There's going to be people in whom which that have dedicated their life, their blood, sweat, and tears, and yet they'll never see this. My goal is to see if I can actually help y'all, so that way essentially you can actually spend that time with your loved ones. Spend your time with your kids. That's what it's all about. A lot of folks out there want to live like rappers and live like rock stars. I'm gonna come off screen real quick, and I'm actually gonna keep it 100 with folks. A lot of folks out there are trying to live, they're living like rock stars, and that, power to them, kudos to them. But yours truly also knows some pretty wealthy people within his circle, and also is from, like, I've reached a certain pinnacle within my life. A lot of the folks that I know don't sit there and spend a bunch of money at Balenciaga or all these different places. They wear some of the most basic stuff. Why? Because they realize that essentially, why go out there and stimulate other retailers when I can build even greater things? They spend more time in investing into their children's education, investing into, say, for example, gaining knowledge. They're not worrying about who's sleeping with who on whatever reality show, or who's who secured the bag. Why spend so much time worrying about who is securing the bag when you haven't even secured it yourself? What's the point? We really have to get to this point where we literally start asking ourselves those questions. It's like, okay, hey, we got to start being real with each other. And it's like, we buy into these whole imageries, these false imageries of okay, hey, that this is what it looks like as it pertains to success. The vision of success is what you make it. So if your children are sitting in the room, would you rather go out there and spend money on a $250,000 car? Or would you rather, say for example, since you talk about like all these things, would you rather go out there and put that money towards, say for example, educational systems to make them better? It's easy for us to always talk about all these other great things. It's easy for us to talk about how bad the system is, but don't sit there and talk about how bad the system is when you're not investing to put the money or the capital or the energy into making the communities around you great. I never understood that. So for me, it's like, yo, this is a blueprint. It may not even be. I don't claim that my blueprint is the most perfect blueprint, but yet at the end of the day, I know one thing for a fact, because that's who Angela Haynes raised me to be. That's who Louis St. Cyr raised me to be. At least I know I can go to sleep today, and if my time ends, at least I know that I gave each and every single one of you the opportunity, so that way you can make something of yourself, build wealth for your kids, your family, and not having to worry about, well, hey, you know, how does our family continue to move on without, say for example, you being in the picture? That's what it's about. You know, when you think about it, wealth is your name that you build. Wealth is what you build for others that you leave behind. I'm not saying go out there and have fun and experience the world, and if you want to stimulate the economy and everything else, do it. But at the same token, it's like, this is a journey. And if you're not willing to go on that journey, cool. But there are people out there, ancestors, who would have slaved to have such an opportunity early on in their lifetime. You spit on the face of every single one of those individuals when you squander your time and energy on things that are of depreciated value or things that don't really matter. I'm done.
I say we just end it there. That was very powerful, and I hope that it resonated with you all. At this time, we're just going to end early so that we can just do what needs to be done. And I hope you all do the same with your family tonight too.
Thank y'all. Have a good night. Keep researching, keep learning. Be kind. Like, just be kind to one another. Like, call somebody tonight and tell them that you love them. And we'll see y'all on Thursday. Until next time, I'm Mark Monroe.